Hi, everybody. Welcome to the IC Topic Chats. Today is Thursday. What day is it? It's the 19th of February. In 2026, we are almost 6 years into this experiment called the IC Topic Chats. It's unbelievable. And one of our um, frequent and hilarious and uh, collaborators is Becky Garrow or Rebecca Garrow, and she's going to talk to us about saving for retirement and the different types of ways we go about doing that. Many of you guys know her. Um, and if you ever find yourself in Sacramento, she will take you on a bike ride. Um, she'd be happy to. Anyway, I'm sure she has a lot better description about herself, and she doesn't like me talking too much anyway. So I'm going to get out of her way. Go ahead, Becky, take it away.
I love to hear your voice. Thank you for that kind introduction. SacramentoBikeTours.com, folks, come visit me. Okay, I'm talking about saving for retirement today. Of course, we have our really important message that comes right at the top. So, 0% of this is professional advice. Do not take any professional advice about investing from me. 49% of this presentation is going to be information. Now, just as when I went to Mexico and everybody told me to get the churro ice cream cone, I personally found I didn't really like it that much. 51% of this presentation is going to be personal opinion. So we put the call out and we wanted to know your questions about saving for retirement as an independent consultant. And we got one email and one survey response. So I don't really know what to make about that. Maybe folks, you know what you're doing, and after this presentation is over, you're going to give me all of your investing tips. Maybe you were nervous. So we're going to keep this presentation brief. Four short parts. First, I'm just going to talk very briefly about the importance of saving for retirement, the different types of retirement accounts that are available to you as an independent consultant, options and considerations that independent consultants might want to take. And then we're going to have a very robust off the record stuff. This is a record if you happen to be joining and you're Gen Z or maybe a young millennial. So we're going to be talking about a few off the record things. I'll be sharing what I personally do, and I have a couple other independent consultants who will be sharing some tips and tricks as well. Couple assumptions. So I'm gonna this advice, this information is geared towards sole proprietors, LLCs, LLCs taxed as S corps. Actually, S corp is wrong. Where the owner is the only employee. So we're talking about single-owned firms. I'm not talking about businesses with two or more employees. We're also not going to be talking about spouses, your big old inheritance that you're getting and you're going to share with me, a pension that you may have if you're working for a university or another employer and you have an employer-sponsored retirement plan for them. We're talking really about that true solopreneur. We're also going to be focusing on people and businesses in the United States. Canada, I know you're feeling special because Bad Bunny shouted you out at the Super Bowl. We're not talking about you today. If you represent one of the groups not included in this presentation, please contact Matt so that you can volunteer for a future independent consulting TIG to talk about this. Okay, so part one, the importance of saving for retirement. I want you to save for retirement, right? The first thing I want you to consider is think about what age you'll want to retire. Most of us are looking at that 65 year sort of target date, right? Some of us might want to retire earlier at 62. Some of us are planning on retiring at 70. Take a look at that. Look at your Social Security estimate. You can go online if you are working in the United States. You can go online right now, create an account or log into your account at the Social Security Administration and see how much money you are projected to receive when you retire. At 62, 63, 64, 65, you can change those things. Decide how much money you will want to have in retirement, and then decide on the best retirement plan for you today. There are going to be differences in how you approach your retirement today. Do you have children? Do you have kids, right? How old are you? How close are you to retirement? What is your risk tolerance? Are you depending on a spouse's retirement or income, right? So first of all, do this. You can Google this, go to the Social Security Administration, figure out how much you're going to have for retirement. We won't go through that. Next, go to a retirement calculator. There are a million calculators, right? I'm just going to use NerdWallet today for no reason. And then I think the name is kind of funny. And I mean, I think evaluators are really cool, but a lot of us like to self-identify as nerds, right? So I'm just going to go to NerdWallet today to tell you how you can sort of plan and get an idea for how you're going to save for retirement. Some assumptions I'm going to use. So by sex in 2024, the average lifespan for males was 76.5 years. The average lifespan for females was 81.4 years. So we're going to use those assumptions when we look at NerdWallet. So let me stop sharing this screen and open up my browser. Okay, we can see my internet window. Perfect. Thank you. You're going to go to NerdWallet or whatever calculator you want to go to online, and you're going to put in some assumptions. So, how old are you, right? Maybe you're 25 years old. You're here, you're just kind of thinking about starting for your retirement. You're an independent consultant, so maybe you're making a little bit more than 60,000, right? 75,000. You have not started saving for retirement. So, let's put a zero there, right? I want you to go down. I want you to hit these advanced details. Think about your retirement age, right? Let's say that I want to retire as early as possible at the age of 62. Your life expectancy, here's where this comes into play, right? So, I mean, the two guarantees in the United States of America are death and taxes, right? So think about what your life expectancy might be. This might be different for some of us, right? So I'm going to go ahead and just kind of go with the average for females. I'm going to put 80. Now, this is a little aggressive. Some of us might say, you know what? I have a long genealogical history. I got people living a long time. I don't want to run out of money. I want to make sure and plan for living to 100, right? Me, I'm going to hope I am blessed to get to the age of 81. Everything else, I would leave this the same. This is very conservative. This assumes you'll have an annual income increase of 2%. Inflation's going to hover around 3%. Again, you're 25, so for the next 35 years, right? Um, and that your investments before you retire will get a rate of return of 5%. Very, very conservative. Historically, this is much higher than that, but we're going ultra conservative today. So, and we're also going to assume that when you retire, you will want 70% of your pre-retirement income. You can change that. Maybe you're like, you know what, I want to do a little bit more traveling. I'm going to need more. So, you are 25, you make $75,000, you have nothing saved. If you save, let me make sure the retirement income and life expectancy. Great. So, if and this assumes again 2% on 75,000 for the remainder of your life. If you save $500 a month, when you retire, you'll have a little over $1 million, but you'll need $1.8 million, right? So let's change this to 550. You're getting closer, right? Let's change your monthly contribution. And let me go back and change this because I'm using that assumptions otherwhere. Getting closer, right? Life expectancy. There we go. So you're going to be short, right? 1,000. You're going to have enough. So I'm making a mistake here because this is really low. Yes. There we go. Okay. So I'm giving you a raise. So if you're at the age of 25, you're making $100,000, you're expected at 2%. And again, normally when we first start out, we're going to be making gains in our some and jump of gains in our salary of like tens of thousands of dollars, not so much 2%. You should be getting within $500,000 of what you're going to need. Let's say I'm 45. I am not going to have enough. If I am doing a monthly contribution of $1,000 and I want to retire at 62, I won't have enough. I'm going to have to change something in this calculation to make sure that I can have. The point here is go in here, start playing around with the numbers and figure out at what age you can retire, how much money you think you're going to need, and how much you're going to need to save in your investment accounts to do that. So let me go back to my screen here. Okay. This is just like rate of return. So we were using 5% as an average annual rate of return. If you just follow the Standard and Poor, you can see that on some years we were pretty low, right? So 2022, negative almost 20%, 2018, negative of 6%. Everything else, if you invested in the Standard and Poor in 2019, you saw a gain of 28%. This is much higher than the 5%. So again, I just want to point out that nerd wallet calculation extremely conservative, which is good for program planning purposes, right? So let's look at this. So I've made an assumption that you start saving at age 25, right? If you save $100 per month starting at age 25, you're going to have $242,000 in any account, right? If you put it in just a conservative account with all of those parameters that I talked about, 5% rate of return, 3% inflation at 65. If you save 200 per month starting at 35, you're going to have a little bit less. If you save 500 per month starting at 45, you will still have less. So this is the power of compound interest, because compound interest when you're retiring is calculated on the principal amount, so how much you put in plus all of your previously accumulated interest. So starting early and being consistent is more powerful than putting in large sums of money later, right? An investor starting at age 25 for 10 years will accumulate more than someone starting at 35 for 30 years. So time is your friend, right? Time is on our side when we're investing. We want to make sure that we're starting immediately, reinvesting our earnings, and then as you get raises, as you get more income, you can contribute more to this. Okay, so you today. I recommend that you consider all the money that you put into your retirement account off limits until you are 62. There are loopholes and there's our loans and there are first time home buyer just for simplicity, pretend that once you put this money in there, you don't need it, right? So for us as independent consultants, you really want to make sure you have an adequate emergency savings account, cash. Our income fluctuates, right? Really, everybody should have an emergency account. When I first started as an independent consultant, the rule of thumb is you want 3 to 6 months of emergency savings. When you're an independent consultant, you want more. You want 6 to 12 months, right? So that you can account for fluctuations. Your retirement account is not a savings account. That is separate. So make sure you are funding both of those things consistently and adequately based on your own personal needs. Okay. Retirement accounts part two. Types of retirement accounts. So there are traditional IRAs and Roth IRAs. One is pre-tax dollars, one is post-tax dollars. These are available to anyone. You do not need to be employed to open up a traditional Roth IRA, right? A SEP IRA is a simplified employee pension individual retirement account. This is available to business owners and small businesses, right? There is a 401k. This is typically employer-sponsored retirement account. There may be a company match. If you've worked at another for-profit organization, you may have had an option to participate in the company-sponsored 401k. There is also a solo 401k and a 403b, which is an individual retirement account for employees sponsored by nonprofits. I'm focusing today on the SEP IRA and the solo 401k. Again, because traditional and Roth are available to everyone. The 401k is typically for organizations that have more than one employee, and a 403b is for nonprofit employees. So for the parameters I talked about above, we're talking about the SEP IRA and the solo 401k today. So just quick, and again, we're keeping this presentation very basic. A traditional IRA, you're going to put your money in before you pay taxes on it. So if you made $10,000 that year, you could take $1,000 before you pay taxes on it, an employee deferral, put that into a retirement account. Had you paid taxes on that, let's say you're in the 25% tax bracket, that means you would have paid taxes on that $1,000. Now you have $750 and it's only $750 instead of $1,000 going into that, right? A Roth IRA is where you're putting in money after taxes. So you've gotten your paycheck, your W-2, the money is your account, you've paid taxes, you're going to invest that. The difference is it comes to your retirement, right? There's lots of nuances in how you can access the money. So I would definitely talk to a retirement specialist about that. But when you go to take this money out, when you go to get your distributions, when you retire, you will pay taxes on the money in your traditional IRA, and you won't for your Roth IRA because you've already paid taxes on those things. There are contribution limits to both of these. For a 401k, the contribution limit in 2026 for those under the age of 50. For people over the age of 50, you are allowed to contribute more to these accounts. They're called catch-up contributions. Post-tax, $7,500. Pre-tax, $24,500. So those are the contribution limits that you can make if you have access to these. I also, when you are opening up your retirement account, want you to think about the expense ratio. So it's not just putting your money in, buying stocks and bonds. This is Vanguard's. So this is from my account. Actually, I have an account. My expense ratio is 0.5%. The average is 0.8%. Industry average, which I'm sure this is why they're putting up here, they like to brag about it, is about 0.5%. This is of December 2024. So there's going to be a cost associated with your retirement portfolio. So let's say you have your portfolio. You put money in your retirement account, right? Now what do? Because you've put the money in there. Now we need to make that money go do something. So again, I want you to ask yourself, when will I retire? Am I retiring in 5 years? Am I retiring in 35 years? This is important because it's going to help you determine what your risk tolerance is. And it's going to help you identify, am I in the wealth growth phase or am I in the wealth protection phase? Am I trying to protect the retirement assets that I have gathered over the past couple of years, or am I trying to grow my assets so that they get bigger for my retirement, right? You should also decide, do you like doing things yourself, or do you want a person or a program to do the investing for you? So you can keep it simple. Let me go back to this one. Do you want a person or program to do the investing for you? Most of us, you can use something where you do not have to go in and individually buy your stocks and bonds. That's for the people who like to do this stuff. If you like to do this stuff, you are definitely not watching this presentation from me. Keep it simple. So think about your risk tolerance, and you can. There's a lot of portfolios that are ready for you. You can decide on a target retirement date. So if I tell my retirement account, hey, I want to retire in 2040, they will invest your dollars. You'll tell them your risk tolerance. And as you get closer to that target retirement date, your portfolio will become more conservative, right? You can also, with other accounts, they might not have a target retirement date. You'll just do a risk tolerance algorithm. When do I plan to retire? What's my tolerance for risk? How comfortable am I losing a bunch of money in the stock market, right? So you can go through an algorithm, but it's keeping it simple, determining your risk. This is an example of one of Vanguard's asset allocations. This is a target retirement date for one of their funds. If you're going to retire in 2050, so if you're going to retire in 2050, they've got you in 85% stocks, 13% bonds, right? Compare this to if you wanted to retire in 2030. That timeline's coming up much sooner. You're going to be 60% stock, 40% bonds, much more conservative. So as the market fluctuates, if you have 30 years, you can tolerate a lot of market fluctuation. If you only have 4 years, you can't tolerate as much market fluctuation. That's from Vanguard. This is from Charles Schwab. So this again is just like a risk profile, right? So if you want to retire at the age of 65 and you are 64, you need to be in that top bracket, in that conservative right there, right? 20% stock allocation. If you are 21 and this is your first job, you want to be in that bottom bracket down there, aggressive growth. You have decades because remember, this is a retirement account. You will not be touching this money for decades, right? And the reason that is if you pull money out, you have to oftentimes pay taxes on it and a penalty fee for pulling those funds out early. So again, this is not your cash reserve. This is not your emergency account. This is your retirement account. We don't touch those funds. So part 3, options and considerations for independent consultants. So we all agree it's very important to invest. We want to do that. We kind of have an idea of how to fund an investment account once we've opened it up. So what do we want to do? Again, these are the accounts that are typically available. I'm assuming we're all in uncomplicated people. We're not doing Peter Thiel's backdoor $100 million into his Roth IRA. So these retirement, maybe we should bleep that out. I don't want Peter Thiel coming for me. So these are the type of retirement accounts, and I'm going to focus on the SEP IRA and the solo 401k, right? A SEP IRA, this is an employer only contribution into an individual retirement account. A regular 401k, this is what many of us may have had before, 401k or 401(b). The company sets up a retirement account, you can contribute to it. There are several employees, right? A solo 401k, you are going to act as both the employee and the employer. You can only have one employee in this company. Or if you have one other employee, that other employee can only be your spouse, right? With the SEP IRA, so I'm going to talk about these two. Um, you will have a business, so your business will contribute money for employees, including the owner, which is you, right? You can only do employer contributions. Your employer contributions can be up to 25% of your compensation. If you make $10,000 that year, that means you can contribute $2,500. If you made $100,000 that year, you can contribute up to $25,000. There's a limit here. The limit is $70,000. So you're never going to be able to contribute more than $70,000. So an example is what I just said before. You earn 100,000, you can put 25,000 into a SEP IRA, the end. SEP IRAs are really nice because they're easy. You don't have to do a lot of paperwork. If you are operating as a solopreneur and you're not doing payroll, you don't give a W-2, you're just doing maybe LLC and it's all pass through. This is a really easy option to set up, right? The other option I want to talk about is the solo 401k. Small difference between the traditional 401k that you would get at a company with multiple employees. So this is where you can do employee and employer contributions. Think of this as like the employee match, right? So in 2026, the contribution limits for anybody, whether you're working at a nonprofit, a for-profit, or your solopreneur organization, right, is $24,500. These are pre-tax dollars. So you do not pay taxes on this money, and instead you defer this, so this is an employee deferral, into a retirement account. That money can grow, right? Same as any workplace. But you can also do an employer contribution. There are a couple of factors that go into how much the employer can contribute. And this is where your state income taxes might come into play too. I will talk about this in the off the record part, because there are some interesting nuances that you can do to really maximize the benefits of this. Rule of thumb, it's about 25% of your income. So same as the SEP IRA, your total contributions cannot exceed $70,000. An example, let's say you earn, same as the last example, $100,000. I put $24,500 into that employee deferral program, so into my 401k pre-tax. But I could also do a company contribution. Let's do $20,000. That means $45,000 have gone into that retirement account, right? Pre-tax dollars. Compared to a SEP IRA, you are an independent consultant, you made the exact same amount, you have a limit of $25,000. The rule of thumb, and again, there's 10,000 nuances to this, right? Is that a solo 401k is usually better than a SEP IRA for consultants making at least $50,000, right? This is just a quick little ChatGPT table because I did not have enough time to talk to one of the amazing data visualization people on here to make me a nicer table. Just a side-by-side comparison. If you're making $60,000 or if you've doubled that and you've made $120,000, the employer contribution when we're making $60,000 will be limited to $12,000 for that SEP IRA. But you don't have a limit with your 401k employee contributions. So your total contribution can actually be $35,500 if you have a solo 401k, right? So the solo 401k again is only available to businesses with no employees besides the owner, with the exception that they can employ spouse. People choose the SEP IRA because it's simple. It's really easy to set up. You don't have to do that payroll. But I did want to please say hello to Jessie Metcalf. She's going to come on and just talk a little bit briefly about the benefits of the solo 401k.
Hi everyone. Thanks, Becky. Yeah, so I will freely admit that I am kind of a solo 401k fangirl. I am kind of a self-proclaimed personal finance nerd. I drive my accountant pretty nuts because I DIY everything. And when I initially got all of my accounts set up, I told her I was going to do a solo 401k, and she tried to convince me out of it. She said that, I work with small businesses all the time. None of my other clients have this kind of account. They all have, either set plans or simple plans, and she didn't really know what the benefits were. So I feel like it's kind of an underutilized tool. Sorry, my dog is barking in the background. Hopefully Zoom is muting that a little bit. So like Becky said, I think she covered, a lot of the basics of kind of rules around the solo 401k. So I won't go too nitty-gritty with that. The only full-time employee you're allowed to have other than yourself is your spouse. So this doesn't work if you have full-time employees beyond just a spouse. But I think, as Becky said on the last slide, one of the real big benefits with the solo 401k is that you can have really high contribution limits, especially in years where your business is really booming, right? So if you truly are maxing out your contribution limits, so unlike a Roth IRA where if you make a lot of money, you're not allowed to contribute or you have to do a backdoor conversion. If you've got a big year in your business, you can put in up to around $70,000. I think it might even be 72 for 2026 in your solo 401k, which is a pretty, hefty amount for a 401k contribution limit. Ultimately, it's kind of the opposite of a Roth IRA, right? This is where a higher business income will increase your limit instead of disqualify you from contributing. Another thing that I like to emphasize, so this is not tax advice, put my little disclaimer there. I am personally a Roth or bust kind of person. I really like having Roth contributions for my retirement because I know that all that money is free and clear. And when I take it out, I know exactly how much I'm going to have. I don't have to, do any figuring of, oh, what's my tax bracket going to be in retirement? Yeah, Matt's also a Roth fan. So I love Roth contributions. And solo 401ks, as of just a couple years ago, both employee and employer contributions can be 100% Roth. So if you have a big year in your business, you can put $70,000 into a Roth 401k account. And that's a pretty unique feature. Another thing I'll mention is that, at least for the account that I have set up, they're really low administrative, burden. So mine are completely free. I don't pay anything monthly or yearly for my accounts. I self-manage everything. Like I said, kind of a personal finance nerd. So another thing that I really love is that I can pick the individual investments in my 401k account. It's not like a here's plan A, here's plan B. You can decide, I want this stock, I want that stock, I want to buy and trade within that account over time, especially if you've got a Roth account. You're all set in terms of, there's no tax implications for making different purchases throughout the years. And I really like being able to pick and choose, which is neat both from the perspective of I'm kind of a high risk investor. I have a long time horizon and I can do things that maybe a standard plan wouldn't do. You can also invest, in a way that feels good for your conscience, in a way that feels ethical for, businesses that you really want to be supporting. So that's another cool thing. Um, and I think that was most of the things I wanted to mention for the solo 401ks, just that, high contribution limit, the Roth options. You can also take loans from a solo 401k. I am not sure if that's possible for SEP accounts. Not always something you're going to take advantage of, but it's something that is, legally allowed as you can take a loan based on your solo 401k account. And then, one more thing that I'll mention, I know we might talk a little more about retirement accounts for family members after the recorded section, but I will note that my husband is my only, W-2 employee for my business. He works for my business anyway. He has a full-time W-2 job at another company, but they do not have matching for their 401k accounts. So there really was not a benefit for him to set up his 401k with his full-time job. So he also has a solo 401k account with my business. We're both those kind of personal finance nerds who like to pick and choose our own individual investments. So it's a neat opportunity if you do end up having a spouse who works for you. And that's been really helpful. And I know, we're seeing in the chat some other mentions. So I personally love picking and choosing my investments, but the other side of the coin is that you can get, low cost index funds in your solo 401k, set it and forget it, have, exactly one, specific index fund and call it a day and, kind of let it grow and do its thing over time, which is really neat. And I think we can talk more after the recording as well about other options that you might have for retirement accounts for family members. I do have a Roth IRA for my daughter. She does a little bit of W-2 work for my business, and that allows her to have earned income so she can get that retirement ball, going early in life, which has been great. So we can talk more about that after the slides.
Perfect. Thank you, Jesse. So we've talked about the solo 401k. We've talked about the SEP IRA. The 401k, as I mentioned, we're not going to talk about, but this is more for the businesses where you have multiple W-2 employees that aren't your spouse. Okay, and now we're ready for the off-the-record component of the presentation. Unless there's any other questions or things that you'd like to add, Jesse or Matt.
I asked a question. So the stock market is crashing. Should I sell?
No. Do nothing. This is yeah, great question. That's actually like a very good question. So, if your contributions are allocated appropriately, you will not need to sell. You'll be fine. Now, if you have a personal account and you like trying to predict the market, you can make a lot of money. You can also lose a lot of money, right? But if your assets are allocated appropriately for your risk tolerance and your target retirement date, right? You can withstand fluctuations in the market. I started investing. If you are a millennial, you've seen a lot of crazy things happen with your retirement accounts, right? As many of us had. So I did hear that a lot of people, they say the stock market crash in 2008 really bothered me. I lost a lot of income there. I should have sold. If you're invested really aggressively and you are very close to your retirement date, that is a risk that you are taking. So no, I wouldn't sell anything.
And I think the big point on all of that is none of us, even the smartest people, know how to time the stock market. And if somebody says they do know how to, they're lying because they don't. Nobody knows how to do it. And what happens when people try and time themselves in the stock market is they invariably miss out on the greatest gains because they weren't in the market. So the advice from again, advice, take it for what it is. I don't have any licensure or anything. I just have a lot of experience doing this. If you're not in the stock market when the gains go up, you missed out. And if you're trying to time it because you sold when it was down and you're waiting or whatever before it goes right back up, you're going to miss it. So stay the course. Don't sell. And there was a question about an ETF too. People ask me about stock tips or whatever, and I've dabbled in a lot of crazy things like early days of Nvidia and early days of Tesla, and those were fun little gambles. Mostly, I put most of my stuff in ETFs because I don't know what's going to do well. Is Facebook better than Microsoft? I don't know. How am I supposed to know? I have no idea. ABC or Google or Meta or these things. So what do? I invest, for me, it's QQQ, which is an ETF, exchange traded fund, which means it invests in everything, all of it. And then you don't have to try and choose which one's the best one. So the expense ratios for what you have to pay for the people who coordinate it are very, very low. ETF is an exchange traded fund, meaning they invest in a whole slew of things and not just like a handful of things that are carefully selected. So that's my advice on that as well, because you don't know, and that's what the best advice is. Anyway, yes, I think this is a good point for us to go into the unsolicited and the unrecorded piece of the presentation. So Emily, do you want to? I'll do my goodbye. So, and then Emily, you can stop the recording. But anyway, everybody out there in YouTube land, I hope you can make it to these Thursday sessions, because sometimes these chats are the reasons why we show up, because there are things we don't want to say on record. So with that, everybody who's out there in YouTube land, we'll see you later. Everybody who's here, stick around.